Hi, my name is Emma Clift and I'm Head of Distribution Services at Momentum Global Investment Management. We hope that you're enjoying the conference so far. Please remember that each speaker's presentation is hosted separately, so you do need to bookmark or join each of the sessions that you'd like to watch, as they won't start automatically. Slide decks are available on each speaker's session and can be downloaded as a PDF. Please rate the sessions and ask questions during the presentations. The chat will be hosted to either answer your questions as they come in, or we'll get back to you with an answer at a later stage. Please also visit our exhibition section, where you'll find all the PDF presentations and some videos that may interest you. On the event feed, please like, rate and comment on photos and videos. You can also create your own event posts. For SA and UK delegates, please remember to click on the Leave button after each session to qualify for CPD points. Otherwise, the development time accrued won't be logged. I'll now pass you over to my colleague, Robert White, who will introduce our first speaker of the day.
Hello everyone, my name is Robert and I'm a Senior Analyst on the investment team here at MGIM. Part of my role is finding the very best fund managers from across the globe to include in our portfolios. And I'm pleased to say that we have one of these presenting next in the form of Mark Baribeau. Mark is the Head of Global Equity at Jennison Associates and runs high conviction growth strategies for the firm. We have used Jennison in our flagship global equity fund since 2012, and in that time they have comfortably beaten the market with returns of over 19% per annum. Mark and his team have added value through investing early in secular growth companies, including the likes of Tesla, Amazon and Netflix, which have all benefited from the remarkable technological revolution ongoing in markets today. Jennison are truly global managers and have generated returns from a number of exciting opportunities outside of the US, including in emerging markets, something which we believe differentiates them from many contemporary peers. While their process has been consistent and durable, they have progressed and grown with the times, and I'm sure you will find the next half hour highly informative and engaging.
Good day, everyone. It's really great to be here again this year. My name is Mark Baribeau, Managing Director and Head of Global Equity at Jennison. Really always excited to come and address this conference. I thought I would talk about three things today. We're going to do a little bit on a market overview, just because it's been such a fascinating time, right? The trailing 1 year, it just seems like the pandemic started a long time ago. We had a big recovery off that bottom. The pandemic's come back and different variants that have kind of set people at unease in the marketplace. We had a big rebound in cyclical stocks, big rotation out of growth stocks, rotation back into growth. A lot of dynamics going on in the market. So let's talk about those. And then I'm going to talk about some secular trends that are in the marketplace today that are really underpinning most of what's happening in the economy and how our economic systems are developing. They're really powerful business trends that I don't think are going to end anytime soon. And then lastly, a portfolio update, just to give you a good idea of how we're positioned, because it's always interesting, right? So let's go to slide 3 in this presentation and talk about the big factor that's happened this year. As I mentioned, we had an enormous recovery last year, one of the strongest years we've ever had in our portfolios and certainly in the markets. But this year has been very choppy. It's been positive, but boy, a lot of aggression on both sides of the tape. So the biggest trend is growth and quality have lagged this year. When you look at this chart, we look at 3 variables: return on invested capital, measure of profitability, that's quality. Growth, both earnings and revenue, so you get a growth characteristics. And if you look at the green bars, it's performance year to date through June. And you can see they're pretty evenly distributed across quintiles of the market. In other words, the slowest growing companies, the bottom 20%, seem to be performing as well as the top 20. And that's very unusual. And that's because growth stocks were really sold off sharply in Q1, and then in the second quarter started to come roaring back. That's the blue bar where you see companies on average with higher levels of profitability, higher growth, are now performing better than their peers, especially when you look at the worst quartile of growth or profitability. That's a more normal distribution in the market. That's what we're seeing. What triggered it? The Fed in mid-May indicating that it might start to tighten monetary policy quicker than expected due to the strength of the global economy and, of course, inflation pressures that came roaring back stronger than expected. That killed the cyclical rally, and ever since then, we've seen the market come back and focus on those companies that aren't dependent on macro, but are just winning in the marketplace with strong fundamentals and very strong earnings revisions. So it's been a very healthy trend. Slide 4 kind of underscores this in a different way. One of the other things we love to look at is free cash flow margins, particularly in technology and internet, interactive media. It's a really important indicator because you can see over a long period of time, going back to 1952, over all time periods, that blue bar, the top quintile of free cash flow margins dramatically outperforms the bottom, which is the other bar. The difference is 2020 through April of this year, totally flipped upside down. The worst quintile of free cash flow margins, more cyclically sensitive companies, dominated performance versus the really profitable ones. That's not sustainable. We're starting to see that correct in Q2, and over the course of this summer, we think we're on good solid foundation going forward, where we normalize back to the stronger succeed, the weaker underperform. If we go to slide 5, another way to look at what's happened in the markets is the macroeconomic contribution to volatility, which is the gray line, in terms of driving returns in the market, is starting to fall away. Just like it exploded in 2008, 9, and 10, in the recession and recovery from the financial crisis, it exploded in terms of its contribution to return or volatility this time around as well, but it's receding as growth normalizes. All that means is stock returns in the future should be more dependent upon individual company fundamentals, not so much macroeconomic trading and guessing and forecasting. The other way to look at it is the blue line in the chart, which is style factor, contribution to the S&P 500's return. It's at a record high. So growth versus value, things like that. Again, as the economy normalizes, you can see that blue line tends to follow the gray line over time. That should recede, and more stock return should just be attributed to individual company success, not so much to style. So these are all trends in the market that we're in the process of reverting back to normal that we expect to continue. If we go to slide 6, just a reminder why we love to focus on faster growing companies. If you look at the market since 1997, rolling 5-year revenue growth, earnings growth, the top quintile dramatically outperforms. And in fact, the bottom quintile is negative. All that's saying is really strongly growing companies, as long as you can get in them before the growth is apparent, really do well in the marketplace. That's why we like to focus there. But it's not so easy because it's not broadly distributed across the economy. It's really quite clustered. So if you go to slide 7, you can see in this cycle, beginning in 2009, earnings growth has been dominated by the technology sector. Tech earnings are up 5-fold since 2009. If you take tech out of MSCI All Country World Index, it's only up 1.8 times. That's still progression, but that's a far cry from 5 times. So the growth has been concentrated in technology. If you look at slide 8, in fact, you can see it illustrated in a different way. Growth is really scarce. If you look at the number of companies that can sustain 15% sales growth over any period of time, it's very small. It's down to 11% of the global market. So one of the ways to think about constructing a portfolio when you're looking for stronger growth, you're not going to find it everywhere. It is going to be clustered. It's going to be clustered in those companies, those industries that are disrupting existing markets and out innovating their competition. But by definition, it's going to be a short list. So kind of an interesting backdrop to the rest of what we're going to talk about. So on slide 9, let's talk about some secular trends that we really think are important today, because they do change over time, right? Every cycle's different. I would argue we're not in a different cycle than 2 years ago. We got interrupted by the pandemic, but the pandemic didn't change the world order in terms of businesses that are winning and losing at all. In fact, the secular trends were reinforced during the pandemic. So let's look at those. So slide 10, we kind of break it down into 3 big buckets. Of course, there are other companies outside of this realm that matter, but it's a good way to think about it. Number 1 on the left side, the most important trend is the direct-to-consumer model. We think about that maybe easily as e-commerce, right? We order something online, it's shipped to our door, that's direct-to-consumer. But it includes entrepreneurs or big brands, big global brands, who also want to sell directly to you, who want to engage with you as a consumer. How do they do it? They need to go through an omni-channel distribution model, which means they do sell online off their own internet site. They also sell in boutique stores, which they own. They control that customer experience, and they get away from wholesale distribution models. And that is a huge, powerful trend out there today, which we're going to continue to exploit. The second is the tech enablers. It's not just it's not easy to do all of these things, right? To start a digital video streaming service, to start an online dating service, to start an e-commerce company. These all require enormous technology to succeed. So the enablers are really important. That's where the real exciting applications come into play. So examples would be digital payments, greasing the skids for commerce around the world in a new format where there's card not present, no cash, you're just using a smartphone to pay for something. It could be retail operating systems, which are optimized for a digital world. So these are powerful, powerful companies. Over on the right side of the page is the most important part of digital technology spending, and that's the digital transformation of the enterprise. You know, if you think back, every major cycle has a big tech boom, right? But they're very different. The 90s were about the birth of the personal computer and that boom, then connected computers leading eventually to the internet, and the 2000 was about the development of the internet, as well as the full deployment of cellular phones or mobile phones around the world. And then this cycle, beginning in 2008, has been about the mobile internet. And it's everything from Apple and the iPhone to applications like Uber. It's just all about goods and services coming off the mobile internet. We think the next big wave of spending is not as sexy, but it's going to be just as important, and it's productivity enhancing. And that's at the corporate level. You're going to see a move to cloud-based computing and cloud-based applications as companies move data workloads and applications off servers on-premise to the cloud. Lower cost, more flexible, more dynamic, more state-of-the-art, and probably more secure. So this is going to be an important transition. Okay, so let's jump to slide 11. Let's go through a few illustrative points that are really fascinating. So I mentioned some companies that were benefiting from these big secular moves got a bump up in the pandemic. Obviously, the biggest case in point is e-commerce. We had a huge step function increase in adoption in 2020. We went from 13.6% global penetration to 18% in 1 year. That's a 2.5-year pull forward of normal migration to e-commerce. So now you're sitting on a much bigger base that you can grow from. The scale is much bigger. Consumers are much more comfortable with it. They're never going to go back. So it's really setting up the next few years in pretty good shape. But one of the interesting trends underneath is where it's happening that's most investable for us is emerging markets ex-China. China is very mature, high 20s penetration. US, UK, countries like that, low 20s penetration. But Southeast Asia, Latin America, single-digit penetration that did almost double during the pandemic, but it's still single-digit, on its way to 20+%. That's multiple years of very fast growth. And in big economies with, each region that I mentioned has 650 million consumers, and many of them young. So the digital age, and they're digitally savvy regions. So we think Latin America, Southeast Asia look very attractive from a technology internet platform perspective in the next wave of e-commerce adoption. If we go to slide 12, the other area is mobile payments, or digital payments in general, still growing at double-digit rates around the world and expected to grow at that rate for some time. But mobile's driving most of the incremental growth. That's the blue part of the bar in that chart. That's mobile point of sale. So it's not just about buying online. It's about using your smartphone or credit card tap to buy any good and service that we deal with on a daily basis. If we go to slide 13, you can see by region, ironically, the dynamic growth is going to be the US and developed markets. It's not so much China. China's slowing down, it's maturing. They are the biggest digital payments region of or country in the world in terms of adoption. They've already almost gone completely paperless or currencyless as the internet platforms have driven massive adoption of digital payments. So the next big growth phase, again, is going to come out of Southeast Asia and Latin America, where these kind of high teens growth rates are actually almost triple digit today. That's where the real opportunity is. The beauty of them is they don't tend to be standalone companies. They tend to be attached to the internet platforms we're invested in, because that synergy is really important. It could be e-commerce in Latin America, it could be gaming in Southeast Asia. It's whatever big platform exists is where the digital payments business is developing very rapidly, and then they can add additional financial services to that wallet that make it a compelling offering. So very exciting trends there. If we jump to slide 14, the other big trend I have to highlight is the move to electric vehicles, because this is going to be the most disruptive trend in the global market for years because it's such a big industry, the automotive industry. And of course, there's one company pioneering EVs and leading the way, it's Tesla. And you can see from this data, they absolutely dominate the market. That's just the Model 3 sales you see on the top of that chart. But if you add the Model Y sales further down the chart, their Tesla Model Y to it, they're at 450,000 units. Nobody's even close. They by far have a lead that they're only going to extend in the next 2 years, given their capacity expansion plans. The other good news for Tesla and other EVs is penetration's really low. That's shown on slide 15. So on slide 15, you can see big markets like the US at the bottom of the page, still less than 2% penetrated in EVs. Long way to go. And we know the world is we know consumers want to migrate in this direction. And regulatory-wise, in places like Europe, they may be forced to. But look how big it can become quickly. Norway is already at 48%. The Netherlands is closing in on 10%. So penetration rates at different markets that actually subsidize and give tax credits for EVs really drive huge adoption because consumers prefer the vehicles. Let's go to page 16 or slide 16. Some mega trends within tech, because it explains a little bit about how we like to position our portfolios. First of all, when you think of capital spending on the left side of that page, you see that technology now has crossed over and is now the number one beneficiary of capital spending. It used to be factories and robots and things like that, plant and equipment. It's no longer, that's not the case. It's technology. It dominates CapEx now. Not surprising to most of us. If you go to the right side, within tech, what's dominating, and you can see that green line just coming out of nowhere and taking the lead, that's software. And there's an expression out there, software eating the world. Like everything we do has software applications and nothing works without software. Whereas the hardware side can be commoditized and not that important to our experience. So whoever controls software whoever can gain critical mass there and get a network effect can have a really attractive opportunity. Plus, look at that secular growth. That's amazing. Okay, let's jump to the next page, which shows slide 17. Cloud infrastructure is where we see the big growth going forward. So data workloads are moving to the cloud. That's pretty clear from this chart. It's annualizing, these are quarterly data, it's annualizing at $120 billion right now. And that's companies like Amazon's AWS, Microsoft Azure, Alibaba Cloud in China. They handle the big data workloads, right, as companies migrated off. Little known fact, but Netflix runs its entire streaming video business off of Amazon's AWS cloud. So, talk about mission critical. Being offloaded to your competitor on their cloud. But it's efficient. That's why they do it. They don't have to invest in servers and all of that technology when somebody else can do it in a better, bigger scale. So, really attractive market. But what we're really excited about today is not just the move to cloud-based data workloads. It's the software applications that are being written specifically for the cloud in unified communication. A company's ability to communicate with us via text, email, voice, video, whatever method works for us, and improve the engagement. That's growing explosively. Infrastructure management, so you can monitor your whole company, manage it via cloud-based applications very seamlessly. Security, workflow automation, really important areas. What do they all have in common? They're software as a service. Their software. That's why we like software. Okay, let's move to slide 19. Quick portfolio update. I don't want to spend a lot of time on this, but it's a good refresher, just so you know where we're maneuvering and what we like out there in the market. So if you go to slide 20, just a quick reminder of what we like to do. We like to identify unique business models that are inflecting in growth. Consumers are adopting their products and services. Businesses love their productivity tools. Whatever it is they're doing is pretty unique in the marketplace and gaining acceptance. They tend to have developed really strong competitive advantages because everybody's going to try to grab a piece of that profitable pie. And so they have to be able to keep innovating and fend off that competition. So competitive advantage is very important to assess. It's also important to be flexible and dynamic. In other words, don't be wedded to certain regions or certain sectors, but just wherever you find those unique business models, if it makes sense from a risk and return perspective, exploit it, because other investors are going to be hamstrung by constraints. So keep it unconstrained, keep the flexibility, just look for the best business models. And so from that perspective, we're bottom up, and that's what we like to focus on. Okay, let's go to page 21, performance. And this is just a short-term view, trailing 1 year, very strong, 37% return versus 33 for the market. That's a nice excess return, but it involved a lot of volatility. Q1 was really tough for us this year as people sold out of growth stocks. We really took it on the chin. It came back strongly in Q2, as you can see from the chart. But year to date, we're still behind the market. So second quarter, nice, 12% return versus 7.4 for the market. That outperformance has continued this summer. As I mentioned, the market is moving back to really stable, high quality, high growth stories that are doing well in the marketplace, regardless of concerns about the Delta variant, concerns about the pace of economic recovery, inflation pressures, etc. The market is migrating to the best business models. So we really like the environment today. If you look at slide 22, from a sector perspective, where has been the action been for us? All in the consumer and healthcare. So consumer discretionary, healthcare, consumer staples, those are the positive charts on this page. Where did we lose money in the trailing 12 months or underperform the market? Our bread and butter, technology and communication services, which is the internet, because they're the ones who took it on the chin in Q1. Now again, they've been recovering since then, but nonetheless, on a short-term view, it's really the consumer and healthcare that have been our strong point. When you look at slide 23 by region, this is really fascinating to me. I mean, the big source of outperformance this year, or trailing 1 year ending July, is emerging markets, 300 basis points of excess return. Developed Europe, really strong, almost 3%. North America, weak, minus 1.6. Why? Because of that tech sell-off in Q1. Again, it's repairing, but nonetheless shows up in the data. So some interesting dynamics under the hood in our portfolio, just so you're aware of it. Slide 24 shows the winners and losers trailing 1 year. If you look at the left side, obviously there's stock-specific stories, like product stories, like a Tesla. That's your number one performer. Wuxi Biologics out of China. It's helping them build out a biotech and pharma industry. It already does that for European and U.S. biotech and pharma companies, so it's not a new thing for them. They're really successfully globally, but they're doing it in China today. Some of the technology enablers I talked about, Adyen, the leader in digital payments transactions globally, headquartered in the Netherlands, optimize their technology stack for e-commerce, and it's really paid off in spades for them. But they also do a phenomenal job on omni-channel, direct-to-consumer transactions. Really important technology application to have if you're going to be in that business. It includes some e-commerce names like Shopify in retail operating system, or Meituan in Chinese consumer services. It includes, obviously, some big direct-to-consumer luxury brands like LVMH and Hermes, who are benefiting not just from a healthy product sales environment, but the ability to control their own destiny through their business model. And then, of course, the digital transformation of the enterprise. The cloud-based applications we own would include CrowdStrike in security, Dynatrace in infrastructure management, and DocuSign in automation, and Atlassian in workflow automation. These have all been big stocks over the last year, and we continue to own them to this day. So those are some really important sort of look at the portfolio in terms of what's been contributing and how it fits in those broad categories I talked about. Page 25 is kind of interesting. Sector changes this year. Not much going on in the portfolio. We cut consumer discretionary a little. We raised communication services, that's the internet, a little. Why? No top-down reason. It's just we happen to be selling out of internet companies or e-commerce companies in China because of the regulatory crackdown, which began last December. And as that weight has come down, it's worked its way into other internet companies that are not categorized as consumer around the world, including in Southeast Asia and the United States. So that movement is a result of adverse developments going on in China. If you look at slide 26, you can see the regional exposures too. Again, not a lot changing here. It's pretty consistent with where we're always positioned. EM down a little bit, developed Europe up a little bit. In a concentrated portfolio, that can be a single name or two shifting weights. But in EM, under the hood, our exposure in China has fallen dramatically. Today it sits at less than 2%. That's the lowest level I've seen in this product. And the reason is, again, the adverse developments in the regulatory environment, the government taking on the internet companies in China. It's going to be very bad for their business models, and we're out. So that's a not so subtle change I want to make you aware of. Thankfully, so far this year, our China exposure has not hurt performance because of our quick exit and steady exit. But it feels good to have little to no exposure. Slide 27, finally, top 10, 42% weight. That's a normal level of concentration for us. So it's very, very consistent with what you've seen from us before. Obviously, there's some names on the list you know well, blue chips like Apple or LVMH. Hopefully there's some names on here, though, that are in that emerging growth category you're not as familiar with, like Adyen or Shopify, which I talked about earlier, or C Limited, the leader in Southeast Asia e-commerce. And hopefully these new emerging growth companies that we're we have very high conviction in and therefore very high weight, become the power of the portfolio over the next few years. So with that, I'm going to stop. But if I could summarize just by saying, one, we think the markets are normalizing today. Everyone's adopted or adapted to the pandemic and its variations, its influences. People have been resilient and found ways around it. And as that growth normalizes, you're going to start to see sort of the separation of the average company from the great company, the most profitable business models, the faster growing companies that are doing something special in the marketplace should again resume their leadership. That's how we're positioned. And again, thank you very much. I'll talk to you later.